Hello and welcome back to the Better Policy Project's YouTube channel. Today we have a distinguished guest speaker joining us, Shalva Mkhatrishvili, the head of Macroeconomics and Statistics Department at the National Bank of Georgia. Our collaboration with Shalva goes way back, and we're excited to have him share his insight with us. During this session, Shalva will delve into the concept of endogenous money creation and explore the risk scenarios outlined in the latest edition of the Not the Fed TealBook.
So this topic of endogenous money creation or sometimes money destruction is especially important when we want to talk about scenarios because many interesting scenarios and some very important ones in the risk management sense, something that Mark emphasizes, is going to come through financial system, and the financial system can propagate different shocks or be a source of shocks on its own. And this is in many instances done through this endogenous money creation or destruction. So what we mean by this endogenous money is essentially bank deposits that banks can create when they lend to households or businesses. And because these deposits are essentially financial liabilities, something that's about promises about future, and because these promises can be made instantly, money creation or destruction can also be done very quickly. And that's the key important part of endogenous money creation process, as opposed to money multiplier or, for example, this loanable funds theory, which tells us that this money creation or destruction, these monetary aggregates behave in a smooth way, and it takes time to either generate credit boom or have some credit crunch. In reality, it can happen very quickly, and that's thanks to this endogeneity of money creation. So again, this is the previous presentation. I wasn't able to attend this meeting, but I had a chance to look at the video, and it's very useful. And this, again, endogenous money creation fits into this least regrets approach to monetary policy neatly, because like I said, it can be a source of very important dark corners. And that's something that we will be calling case B scenario. So how can this case be motivated? Like I said, this money creation or destruction is usually sometimes can be very quick. And whether it's quick, it depends on initial conditions of the economy, whether we have a significant vulnerability so that there can be sudden realization by either commercial banks or by borrowers that there is high risks in the economy, and this sudden realization, reappraisal of risks in the economy can generate quick increases in banks' spreads or bank lending conditions, and that can quickly generate some credit crunch and therefore destruct money. Like I said, bank lending or households or businesses borrowing is a source of money creation, and if it's done, if it's stopped instantly because of some fears of something similar to, for example, global financial crisis, that can quickly destruct money. Something that we also can call deleveraging. And quick deleveraging is essentially money destruction that can generate a big recession and actually force central banks to lower interest rates aggressively to fend off these recessionary impacts. One risk that can, for example, generate this kind of scenario is realization that the borrowing that has been done so far has been against collateral, which can lose value quickly. Something, for example, houses lost value in before the global financial crisis, and that was an important part of banks tightening lending standards back then, suddenly realizing that risks in the economy are so much higher, and therefore they essentially stopped lending, and deleveraging took place, which again means money destruction and therefore quick and painful recession. Something similar can happen now. For example, this data from China is especially worrisome if you look at the stock of residential real estate investment and prices of houses. If you, for example, compare these house prices to average annual income of Chinese people, you see that prices are very inflated relative to their annual income. That means, for example, it can take 50 years even if they use their annual income to buy houses, to accumulate this money over time to buy a new house. It may take almost 50 years. That's a big difference between house price and households income. That can be a source of banks suddenly realizing that the housing prices are too high, and if house prices decline, that can quickly generate this credit crunch type scenario, and therefore deleveraging and money destruction. And again, because this money destruction is endogenous thing and depends on bank lending, which can stop quickly, this deleveraging recession can also be something that we can see down the road relatively quickly, as opposed again to loanable funds theory. Another type of vulnerability, in addition to asset prices, is credit extended to the real economy. Again, we know that asset prices being elevated and credit extension being especially active relative to GDP. Those are two important indicators of financial vulnerabilities, and therefore some can be a source of banks realizing these risks after a while, and therefore stopping to lend to businesses and households. Again, even in addition to asset prices being inflated, for example, house prices, the credit to GDP has also been very high. We may be a bit complacent if we look at credit to GDP ratio within a standard approach of FPAS, which is HP filtering these credit to GDP ratios, and therefore, because this is a standard approach of HP filter, it essentially tries to draw a smooth line along these dynamics of credit to GDP ratio. But we know that if we use this approach and extrapolate into the future, it generates very unrealistic predictions for credit to GDP in 10 years or 20 years time. And that's simply a mechanical exercise to look at. And even based on this simple argument, we know that there ought to be some credit to GDP level that's safe and beyond which we may be worrying about too much debt in the economy. And this is something that's been taken care of by this recent CBA working paper, which extends this HP filter in a nice way, which in a very simple way, but it neatly incorporates this concept of safe level of debt, debt above which we may be forced to slow down lending or inflate GDP so that we push credit to GDP down. If we incorporate this idea that credit to GDP beyond some level is unsustainable, then we can see that this current level of credit to GDP, for example, in this case in China, is about 20, for example, based on this calibration used in this paper, it's about 20% higher than what we call the safe level. Of course, we don't know safe level of debt itself. This is unobservable, but we know that there's ought to be some level beyond which we are prone to this sudden realization of banks that riskiness of their existing credit is too high, and therefore they may be forced to cut lending in the future, and therefore generate this money destruction and recession, painful recession. So again, these are just motivations that this scenario is relevant and it's related to current data. It's important to look at because there's a chance of this happening, and we need to be preparing for the worst. Again, consistent with the least regrets approach to monetary policy. Now, going back to the US case, We know that there has been some financial difficulties in some financial institutions like Silicon Valley Bank, and this led to, and other financial institutions as well. This has led to bank lending tightening, banks tightening these lending conditions, and therefore generating this tightness that can be a source again of credit growth slowing down, potentially significantly, money being money destruction, and therefore this recessionary impulses. So what's important in this case is how this will depend on Fed's policy. Of course, this is the whole idea of having this case A and case B is to somehow set policy that minimizes these risks of dark corners, these scenarios that we fear the most. In the case of Fed, this means that they have to walk this fine line between avoiding inflation becoming unanchored and avoiding these big difficulties in financial institutions that can lead to money destruction and painful deleveraging. What's the market is thinking about this is that the Fed will probably maintain relatively policy that is relatively less tight than the Fed itself thinks will be necessary, which can mean one thing, one of several things, but one possible explanation of this, of like the market underpricing the interest rate hikes. One of the reasons of this can be that the market is somewhat complacent about recent inflation dynamics, which shows significant deceleration. But if we look under the hood, we will see that inflation has been coming down mainly on because of food and energy prices, and those are components that are volatile and therefore may not be a very good indicator of what the future might look like. Instead, if we look at inflation measures that show some underlying forces, like underlying inflation measures, like sticky price inflation, we see that inflation is still an issue. So that the Fed is again between these two evils, whether to tighten more to make sure the inflation goes back down to its 2% target, or is this tightening enough to generate sufficient bank stress, like banks tightening lending conditions that will generate enough recession to reduce inflation going forward. So we've discussed these case A type scenarios in previous meetings. Today we will show what this sudden realization of riskiness of the economy and banks tightening their lending standards might imply for the Fed's policy going forward. So again, just a quick summary of what we mean by money creation or money destruction. It's essentially banks providing loans to households that are used to spend on consumer goods, non-residential, or they can also spend this money on for example, housing. They may even buy some financial assets, but that's usually a smaller part. Similar for firms, businesses take loans from banks, and when banks again decide that firms like households are good borrowers, if their credit risk is assessed to be relatively low, they will extend this credit to them, and in the process create new purchasing power that didn't exist before. That's the money creation part we mean. And again, firms using this newly created money, they can spend this on labor, inflating wages, for example, pushing demand up this way as well, or they can use this money to spend on investment. And in reverse, if banks suddenly realize that those firms or households are no longer good borrowers, then they can quickly stop lending, and therefore this process can start like a continue in reverse. Less spending, less impact on demand, and therefore lower inflation. And one key channel that this sometimes works, and when this is working through this particular channel, it's especially painful, and that's through bank lending tightening, what we call this BLT index. So this is essentially net percentage of banks that have been tightening lending conditions. That can take the form of interest rates. They can be increasing their spreads over and above, for example, Fed's policy rate, or they can also do some credit rationing. They can either they can simply stop lending to businesses even without increasing interest rates. So this tightening lending standards, if it's gone too far, it can be a source of a painful recession like a global financial crisis. As you've seen, we've seen this during this global financial crisis, bank lending tightening index has increased significantly to almost 100%. Almost all of the banks tightening their lending standards and therefore stopped lending, which again means deleveraging, money destruction, and therefore quick erosion of purchasing power that can be used to spend on goods and services or assets, and therefore generating this disinflation that the Fed had been fighting of since global financial crisis for like a decade. So that's something that can still happen, and therefore that's why we are paying attention to this bank lending tightening index. And especially this is important because, like I said, during last several months, we've seen these issues popping up in the US financial system when several banks had this difficulty either being shut down and therefore quickly stopping lending, or even existing banks increasing their spreads over policy rates, or just simply tightening their lending standards and therefore slowing down credit. So if this continues, then we may be looking at significant recession, something similar to what people call hard landing, and therefore this is a realistic and relevant scenario to take into account when setting policy rate. So because this is again important to understand and look at these banks tightening their lending standards, and because this can happen quickly, and therefore because money creation done by banks is a significant source of nominal demand that can mean a lot for Fed policy rate, for inflation, and therefore for Fed policy rate. That's why we have generated these several scenarios, which the core of these scenarios goes through this bank lending tightening variable, which in the model these scenarios are based on is essentially composed of two important parts. One is bank lending tightening. Banks tightening their lending conditions depend on their expectations of future demand and future GDP, future output gap, more specifically. And they are also composed of something that's similar to residual, like a exogenous part of bank lending tightening. And that can be something that stands for banks, financial systems, perceptions of the riskiness in the economy. And if this riskiness suddenly increases, for example, again, this Silicon Valley bank, apparently they hadn't realized the risks to be as high as they actually turned out to be. If this is the case for other banks, if they realize that the riskiness of the economy is higher than they thought, then they will just simply tighten their lending standards and therefore generate these deleveraging, recession, and lower inflation, and implying this for the Fed, implying these lower interest rates that we've shown in this scenario. Again, there are three scenarios here. One is smooth waning of these recent tightenings in the BLT index, banks realizing that they've reacted to this recent Fed policy tightening. They've also tightened their lending standards, but this is going to wane off gradually, and therefore this is a relatively smooth version or mild version of case B scenario. If things turn out to be more fragile, if we are more vulnerable to these financial vulnerabilities like inflated asset prices or high credit to GDP gaps, and banks may be forced to realize this higher riskiness and therefore to tighten credit standards even more. That's this middle line, this yellow line shows this case when banks realize that riskiness is high and therefore they continue tightening bank lending standards, but we're not all the way to this global financial type of scenario. And the third one, which we can call this triple B or scenario 1 GFC, which is in green, is essentially having this scenario where markets, financial market participants, banks in particular, realize that risks are much higher, then credit extension is no longer profitable within this riskiness unless they increase interest rates on their loans too much, or if they deem risks to be excessively high, then we'll just stop lending and we'll have this credit rationing and therefore deleveraging, money destruction, which means lower nominal demand and in the sense of sticky prices, this usually means lower real GDP, lower output gap is almost, and in this scenario, we have almost as big an output gap as we had during the global financial crisis. This naturally implies lower inflation pressures. And because the Fed will be fearing this repeat of global financial crisis, low inflation, and secular stagnation type of scenario, they will have to be prompt and they will have to quickly reduce interest rates back down to zero essentially and stay there, communicate staying there for a while so that bank lending tightening variable is eased again so that they avoid this even worse recession and inflation becoming too low again, something we've seen before the COVID crisis. So that's the case B type scenario. Where we understand that this money destruction through banks, realization of riskiness of the economy and financial system can lead to money destruction, painful recession, and lower inflation going forward. Then that's something that may justify this recent pause that the Fed has done, and they will be waiting for. Importantly, not only inflation, but like we mentioned, some indicators, either the bank lending tightening index itself or something that proxies this, like a spread, interest rate spreads over and above a Fed policy rate that's in the financial market. So that's pretty much it that I wanted to emphasize. Thanks, and if you have questions, we can dig deeper.